All right, welcome to Holmquist and Gardner's webinar for April 2025. We are covering today insurance coverage considerations for real property owners. We can move on to the next slide. We're very excited today to have a great guest who I'll get into in a second, but before we do that, I want to note that we are trying a new format today with some better photography and video footage. So as we go through that, just know that we're learning as we go, as always, and that's kind of part of our jobs as attorneys, is to be constantly studying. That's why they call it the practice of law, and so we appreciate you bearing with us on that. As always, for our webinars, this is for informational purposes only and should not constitute or does not constitute legal advice. You're going to be hearing some stuff today that, of course, we hope is adding value to what's going on in your lives professionally, but we do want you to go and seek independent counsel to get clarification on any issues you have or anything we say that might pertain to your business. Holmquist and Gardner is a 10-attorney firm focused on real estate and business law. Within that, we've got a litigation department and a transactions team. On the transactions team, we're buying, selling, leasing dirt, helping people manage their real estate, and of course, insurance issues in that. And within the transactions team, we also are excited to have developed an estate planning team. So keep that in mind. And today, we've got a very special guest, Greg Pendleton, comes to us from the law firm of Gordon, Tilden, Thomas, and Cordell, which he'll tell us a little bit about. Greg and I go way back to the fraternity days at the University of Washington. And since then, Greg's been a resource for our firm and our clients on insurance and coverage issues. Like many areas of the law that we don't cover, we go to people that know what they're talking about and actually are living in it and breathing it every day of the week. And we've had nothing but success in working with Greg and his firm. So with that, Greg, why don't you tell us a little more about Gordon Tilden, and then we'll get into some of these coverage issues, insurance issues.
Thank you, Imants, and thank you, Holmquist and Gardner, for having me down here today. My firm, as Imants mentioned, is Gordon, Tilden, Thomas, and Cordell. We are primarily business litigators. Several of us, roughly 10 of our firm, focus almost exclusively on what we call policyholder insurance recovery. So in this effort, we try to help people who purchase either liability or property insurance maximize their recovery from their insurance companies. And this often finds us in litigation against insurance companies. We also do a little bit of personal injury, trust and estates litigation, and general business litigation. We've been doing this for roughly 30 years throughout the Pacific Northwest, and like to think of ourselves as, among the leading insurance recovery firms, certainly in Seattle and in the region.
So with that, just as a practical piece of how they fit into the realm of operations, we'll be going along, everything's fine, property's stabilized, and then of course there's an insurance claim that comes in. We're going to talk a little bit about what it means to tender and all that. But we'll start it up, get it tendered, and then all of a sudden there'll be an issue where the carrier either doesn't cover or sends a reservation of rights letter that's pretty complicated, or there's some other issue that happens with the coverage. And that's when we bring Greg and his firm in to try to help out, figure out what's going on, isolate issues, and then if necessary, potentially send some kind of letter addressing the issues and helping the client get to whatever should be the true outcome of their insurance that they paid for. So today we're going to just go through some basics. And while we're doing that, if you have questions, go ahead and type them into the Q&A. A few of you already jumped on sending us some questions, so we've got some for that. We're going to try and keep it fairly informal, go through a few slides, cover the topics we talked about, and then at the end, try to answer a few questions. If we don't get to anything, by all means, we'll have our contact information up, and we're recording this so that you can share this with your friends and colleagues and also come back to it. And we look forward to sort of getting after those questions and answers. With that, we're going to cover tendering, casualty, and CGL claims today. We're going to cover the claims process a little bit, talk about some common coverage issues, and then hopefully have time left for a little Q&A. Take it away, Greg.
Perfect. Thanks, Imants. So I figured we'd start with the liability side of the equation as opposed to the property side. And so liability insurance is just as its name implies. The policyholder purchases an insurance policy to protect it if and when he or she or their business is sued by a third party for some alleged wrongdoing. Let's first talk about the types of liability insurance we have. Some of you may have heard the phrases claims made insurance or occurrence insurance. Your typical general liability policy that you purchase for your business, and it's also the one you have on your homeowner's policy, is called an occurrence policy. And what that means is that the policy that was in force at the time of the alleged injury to the third party is the one that responds to the lawsuit or to the demand letter that you get as the policyholder. This is to be distinguished from a claims made insurance, which is insurance for professionals like lawyers, architects, directors and officers, also employment insurance if you have a business and you have insurance covering your allegations of discrimination, for example, by your employees. This is written on what's called a claims made basis. These distinctions are important because claims made insurance, what matters is the date the claim is made against you, the policyholder, as opposed to the date of the occurrence of the accident. And if you don't timely tender a claims made insurance claim within the 1 year window of your policy, you can be totally out of luck and not get any insurance, even though you bought it. So it's sort of a procedural gotcha. And it's particularly important that you as the purchaser of insurance know what type you have and know to promptly tender, in particular, claims made type allegations.
And we would say tender promptly no matter what. But in this case, it's not just for good practice, it's because you literally could just have no coverage.
Exactly right, exactly right. And under occurrence policies, Imants is correct. You should always tender promptly, but you have an argument as a policyholder that unless the late notice prejudices the insurer, you should still get your insurance. That prejudice analysis is irrelevant in claims made coverage. You should consult with your broker or the person you purchased insurance on these questions, particularly on that differing nature, and have them help you tender claims. So when a claim comes into you, be it a trip and fall at your place of business or an allegation of employment discrimination, pick up the phone, telephone your broker, and have them help you put together the claim form and submit it to the insurance carrier. If you don't have a broker, your policy will almost certainly have a description, including an address, physical address, and an email address of where to tender claims. And so you should follow those instructions in the insurance contract for doing so. One of the key aspects of liability insurance is coverage for a lawyer to defend you, the policyholder, in the liability action being brought against you. Legal fees are expensive and in fact can be more expensive than settling or even paying a judgment. So it is a key aspect and the first aspect of liability insurance. And we call this the duty to defend that is imposed upon the insurer. Washington in particular has a very robust duty to defend. The standard is even if one allegation in a long complaint is quote unquote conceivably covered, the carrier needs to defend you, the insured. So you could have a 50-page complaint and only a couple paragraphs, fall within the scope of the coverage provided by the insurance policy. The carrier still has to defend you for the entirety of it. In that situation, what should happen is the carrier will send you, the insured, what's called a reservation of rights letter. And that letter will say, hey, we've reviewed the complaint or the demand letter. We acknowledge that we have this duty to defend, but we reserve rights, hence the phrase reservation of rights, to later refuse to fund a settlement or a judgment against you. And then it should list out the exclusions in the policy or the terms and conditions under which the carrier might later rely on to say, well, we're going to pay your legal fees. We're not going to fund a settlement or judgment. Any doubts about this duty to defend should be resolved in favor of the policyholder. This is one of the bedrock principles of Washington insurance law. Kind of the tie goes to the policyholder instead of the tie goes to the insurer. And that's public policy based on the traditional unequal bargaining power between a person purchasing an insurance policy and a large insurance company that sells thousands of these every day.
I think that's something that we can tie throughout the whole process of insurance, is that generally Washington State is going to say, if you're in a courtroom and you're the policyholder and the insurance company didn't play along, that the tie is going to go to the policyholder.
Yeah.
Which is why it's so critical to follow, Greg's guidance here on getting this tendered properly, following all the basic rules, because you already get a leg up. Your only leg down or kind of out is if you just don't follow these basic best practices.
Right. And Washington is known around the country as one of, if not the most policyholder favorable jurisdiction. And so if you get a letter back as a policyholder and the initial response from the insurer is, hey, no, we don't have a duty to defend, good luck, go hire your own lawyer. It is frequently worthwhile taking a second look at that and calling someone like Imants or myself and saying, this seems maybe like it's not right. And then a pushback letter to the carrier will often get them to change their mind and then hire a lawyer for you. The second type of defense that is much less common is called an unreserved defense. And that's when you tender a lawsuit to a carrier and it says, great, we got you, basically. That might happen in a common slip and fall or premises liability case, or maybe a case of obvious medical malpractice or something. Usually the carrier wants to say, we'll defend you, but we're going to reserve rights to not pay a judgment. Sometimes they will say, we will defend you and we will pay any judgment up to the limits of your insurance policy. So if you have a $1 million policy and the jury returns a verdict of $900,000, the carrier's got you, nothing to worry about. The critical thing there as the policyholder is just to make sure that you have enough insurance. And if you are worried about a judgment in excess of verdict, then, in excess of your policy limits, then again, it's good to consult with a lawyer about what to do in that situation, because there are options.
And I think that key piece there is you get that initial response saying reservation of rights. I know for me and a lot of my clients, the gut reaction is like, what do you mean you're reserving rights to come after me later? It's so common that I would say, in my career at least, the one time we didn't have a reservation of rights was one where the carrier was coming in to pay really quickly because there was a time-sensitive coverage issue. We didn't even get a acceptance of coverage. They just came in, wrote a check like it needed to happen. And every other one that we've tendered has been, yes, we accept, but we reserve all rights. And there's a couple pages of CYA on behalf of the insurance company. So don't be afraid if that happens.
Exactly. Yeah, that should be the expectation. That you get what they call an ROR, the reservation of rights, rather than an unreserved defense. And practically speaking, because 90+% of lawsuits settle before trial, what this means is if you have a mediation with the party suing you or informal negotiations, you have side negotiations with the carrier about how much or all of it they are going to pay, even though there's a reservation of rights out there. Which brings us to the issue of the insurance carrier's duty to settle. This is another key duty in Washington insurance law. And it imposes upon the insurer a good faith duty to affirmatively settle a lawsuit against the policyholder if there is an option to do so within the limits of the insurance that the policyholder has purchased. So it's not reasonable for a carrier to say to me, for example, if there was a lawsuit against me and I said, hey, I have $500,000 worth of coverage. The plaintiff will settle for $200,000. I want you to settle it. And the carrier says, nah, I don't want to do that, because you've paid a premium to transfer the risk of that loss onto the carrier. And it would be unreasonable, barring some, watertight coverage defense, for the carrier to say, no, I don't want to pay that. Good luck.
And I think this issue really highlights the need to have either coverage counsel or your general counsel sort of quarterbacking, which is a role both of us sort of play, even if the insurance company has hired defense counsel for you. Because this is a thing where you could be 6 months into litigation and only have insurance defense working for you, and you wouldn't be aware that there was this duty to defend, duty to settle. There's been a few settlement options put on the table, maybe even a mediation. It's just wise to get that extra attorney. And again, it sounds like maybe we're trying to add attorney's fees to your tab, but this is a case where that might not be immediately obvious or apparent.
Yeah, and what you will find if you're in a situation where the carrier has appointed a lawyer and is paying that lawyer's bills to defend you, that lawyer is not going to get involved between you and the insurance carrier on issues like pressuring the insurance carrier to settle or arguing whether their reservation of rights is valid or not. That carrier's focus is going to be on defending you in the litigation and really that only, which is why having an advocate, either as a lawyer or your claims department at your brokerage, someone else helping put, leaning on the carrier to cough up the money to settle, because the appointed defense lawyer that they are paying for is not going to.
And I don't mean to knock appointed defense counsel. They're great, and they do, in most cases, a wonderful job. But this is a place where they have a relationship in a lot of cases with that insurance company. So yeah, they're under all their ethical obligations as lawyers to act in your best interest. But they also get a large portion of their work from that insurance company. So it's important to just keep that in mind as you move through that.
Yeah, absolutely. Their sole client is you, the insured, not the insurer, even though the insurer is acting as a third-party payor. But the scope of their engagement is going to be limited to defending the underlying lawsuit, not advocating for coverage. Okay, so let's talk briefly about what happens if the carrier breaches either the duty to defend or the duty to settle. What are the consequences, and what tools does the policyholder have at his or her disposal to try and remedy that breach? One of the things we frequently do is write demand letters, and if those don't work, file what they call coverage lawsuits, making allegations that the carrier is acting unreasonably, or the buzzword is in bad faith. Excuse me. There's also statutes in Washington, the Insurance Fair Conduct Act and the Consumer Protection Act, that are arrows in the policyholder's quiver to try and get the carrier to pay the money. Bad faith it's just a fancy word for acting unreasonably and improperly putting the insurer's interests ahead of the insured's interests. Part of the relationship between the insured and the insurer, they call it quasi-fiduciary, but meaning the carrier is not supposed to elevate its own financial interests in saving a buck over the insured's interest in getting this case settled and protecting their own personal assets. And the Insurance Fair Conduct Act is a statute in Washington that if a carrier acts really badly, you can get treble damages as a policyholder. So if they deny coverage and they're totally wrong, essentially, there's an argument, and you can go to the court in state court or the jury in federal court and say, they acted so badly, and not only did they withhold my $1 million of policy benefits, you should double or triple that amount as kind of a punitive sanction against the carrier for acting badly. Again, these are rare, but it is leverage to threaten that you can sometimes get some movement from the carrier to cough up more money.
Those would be pretty extreme cases and fact patterns, but this act strikes me as a Consumer Protection Act. Does this apply to our commercial property owners as well?
Yes, although I will say, the case for multiplied damages is certainly more compelling. If it's a homeowner his house is burnt down and they've been displaced and their family is living in a motel, than a large warehouse owner who thinks their claim is $10 million and the carrier only paid $8 million.
Sure.
So the facts matter on these things, but absolutely, it's not just personal lines coverage that Insurance Fair Conduct Act and the CPA applies to. It's the whole insurance industry.
Great.
Excuse me. Also, in coverage litigation, if you are a successful policyholder and you sued your carrier and you win, you get to recover your attorney fees, both as a matter of case law and under these statutes that I mentioned, which is an exception to the traditional American rule of everyone pays their own attorney fees, regardless of whether you win or lose. Many of you out there, commercial property owners, you might have property management agreements that have fee shifting clauses in them. So this may not be totally foreign to you, but normally if you're a litigant and you want to fight, and even if you win, you're paying for your own lawyer out of your pocket. This is this ability of policyholders to recover their attorney fees is another consumer-friendly rule that Washington's legislature and courts have developed, and also, again, is something these carriers think about when they decide, boy, do I really want to fight this coverage lawsuit? Because not only will I have to pay my own insurer, I might have to pay the other side's fees.
Yeah, and this is extreme. I mean, you look at the statutes, there aren't a lot of other places. I mean, if we have a boundary line dispute, for example, you're not getting your attorney's fees. If you have a easement that's there and it's unwritten, but it is an easement, no attorney's fees for enforcing that. So there's a lot of areas of the law where the standard rule applies, and it's kind of a bummer because there's obvious malfeasance, but we just can't make it happen. This is not one of those.
Correct. Yeah.
But I will caveat that by saying the strength of that threat is only as much as the firm that's making it has actually pursued those to fruition, meaning judgments and all the way through the Court of Appeals. And not to plug Gordon Tilden too much, but one of the reasons they have so much success in this is they've been there, they've done that, and the insurance companies are aware of that. So that threat is very real.
Yeah, and sort of the last piece of the liability insurance I wanted to talk about is kind of the nuclear option for policyholders, and it's called a covenant judgment. And this is when you as a policyholder have tried to get your insurance carrier to fund a settlement that you want to get funded because you're worried about the liability risk and the damages exposure, and you and the insurance company just can't reach agreement. You have a very different view on the risks of going to trial, for example, or the insurance carrier thinks their coverage defenses are rock solid and you disagree. Occasionally, the plaintiff in this situation will approach you, the policyholder, directly and say, you know what, I'm willing to take what's called a covenant judgment and an assignment of your rights under your insurance policy. So you, the defendant policyholder, will agree and stipulate to a judgment against you. So yes, the plaintiff's allegations can be proven and there's a judgment entered that you did XYZ wrong. In exchange for that, the plaintiff agrees not to execute that judgment against any of your personal assets. So it's bad on paper that there's a judgment against you, but there's no financial repercussion, at least immediately on that. In exchange, you, the policyholder, then assign the plaintiff your rights to your bad faith claim against the carrier. And the plaintiff then steps into the policyholder's shoes and essentially sues your insurer for bad faith failure to settle. And then you're done with it. You say, good luck. And the plaintiff is now, instead of litigating its liability case against you for having done XYZ wrong, is now litigating a bad faith claim against the carrier, saying the carrier acted unreasonably. Plaintiffs like this because the judgment amount is usually quite high. It can't be collusive and it can't be unreasonable, or a court will cut it down. Yeah. But if they're claiming $10 million worth of damages, they'll put a covenant judgment in for 10 million or 11 million, rather than the 4 or 5 they might get at trial or you might negotiate, and then they're trying to collect that from the carrier. So this is rare. We have done it a few times on behalf of our policyholders, and it's usually critical when the policyholder's really only asset is the insurance policy, or they're worried about exposure of their home or their business, and they can protect that by essentially wiping their hands of it and giving the bad faith claim to the plaintiff. Okay, so should we move on to property insurance claims?
Yeah, definitely, yeah.
Okay. So of course the duties to defend and indemnify don't come into play here because there's no third party suing the policyholder. Property insurance is what we call a first party claim, where the only parties to the dispute are the policyholder himself and the insurance company. So think a fire in your building, a sprinkler pipe bursts and floods. These are property insurance claims and first party claims because there's no one else saying, hey, you property owner did something wrong. Yeah. It's just a
roof drain, failure to maintain,
yes,
leak situation.
Yes. And the key here is leading the horse to water. Particularly property insurance adjusters, all insurance adjusters are busy, they're overworked, they are human. They have
unlike us attorneys.
They have dozens, if not hundreds, of files on their desk. And if you can make their life easier as the policyholder by being extremely organized, and pointing them to where you want them to go, you will find most often that it's easier to get there with less fighting than kind of sending them an email with 65 attachments that don't explain what's going on. So in terms of organizing this at the beginning, if you are a property owner, particularly a large property owner, getting a good broker who knows what they're doing is critical. How much insurance do I need on my building? Everyone is aware that the cost of rebuilding has gone up dramatically over the past decade or so. And so if you are just renewing your policy every year and kind of adding 2 or 3% to values for inflation, and that's all you've been doing for 15 years, it is very likely that, the limits are insufficient on your current building. That may result in some modest premium savings for you, but if you have a catastrophic loss, it is also very likely going to result in a huge shortfall between the amount you can recover from your carrier to rebuild and the amount it actually takes to rebuild. So I recommend every 3 to 5 years getting an appraisal done, or having a knowledgeable licensed contractor come and walk through and say, hey, if this burned to the ground, how much is it going to cost me to put it back together? And have accurate values reported on your applications every year to your carrier, because then you can avoid these expensive fights and the very unfortunate situation that we see quite often of people saying, hey, I had $3 million and we had a large loss, and it turns out it costs $4 million to rebuild. Where do I get this extra?
Well, and I think this is a key inflection point to just reflect on why you have a good brokerage working on your behalf. And it's basically 3 key points. And there's no better place to put it than right at the claim preparation side, because we hope we never get there. But the first is that a good broker is going to review this stuff in detail regularly. And if they really know what they're talking about, they're going to help you adjust these limits. The second thing is that they're going to talk about what kind of coverage is there, and then be there for you in the claims process to help, as Greg mentioned earlier, submit that claim. And the third area where they can be of assistance is actually in all the drafting of contracts that we use. Typically, a good brokerage with a sophisticated team and experience in that field is going to be able to offer insight as to, hey, this is not reasonable anymore. We've been using different language in leases with regard to this type of coverage. You should update it. Or the policies you have in place aren't in compliance with that. And so, point 1 is how your relationship is with your, what we call insurance advisor, because it could be a brokerage, they have different names and all this. So check there first. And Greg has a lot of these. We have a ton of unfortunate stories where that 1 to 3 year to 5 year review process got overlooked. Coverage was not sufficient, or actually the premiums paid were much more than they should have been for what the client got, because they went to a friend or relationship rather than changing around and sending out, doing your due diligence with regard to which brokerage to go with.
Yep. One of the things those brokers can help you with, we have noted here, is statement of values. So if you are a property owner with multiple properties, you often insure them on one master policy. And as part of your application every year, you typically submit a statement of values where you have your anticipated replacement cost value for your building. You have your anticipated lost rents for your building, for example. You want to make sure these things are accurate. And then when you purchase insurance for a multiple property portfolio, it's either going to be written on what they call a blanket basis or a schedule of value basis. Blanket meaning you could purchase a $50 million limit for all 10 of your buildings. And if one of them burns down and it costs $48 million to fix that one, you're okay. If you have a scheduled basis, each one of those buildings is going to be individually valued. And if that individually valued building is valued at $10 million, and it turns out it costs $48 million to fix, you're only getting $10 million. So you have to be very careful to understand whether you have scheduled limits or blanket limits. Blanket limits, in my view, are preferable. They are harder to get and typically more expensive. Scheduled limits, you just have to understand,
that you need to have accurate limits for each of those buildings in your portfolio, and that if you have a loss, there is almost certainly a clause in the policy that either incorporates the statement of values or says, we, the insurance company, have a liability limit that's reflected on the statement of values or reflected on this endorsement that schedules each building. Because we have also had claims where people thought they had a blanket limit and they did not, and that created a lot of heartache.
Yeah, and a key point with all of these limits is, for real property owners particularly, is making sure that's in compliance with their loan obligations and their loan documents. And sometimes the loan document settings are actually, not as aggressive as what you probably want to do. And so just relying on your lender's approval of the insurance that you got may not be sufficient. Just make sure to double check and work with your insurance advisor to get the best option.
Yeah. Another key aspect of property insurance are sublimits within your policy. So say you have a $50 million policy, you might have within that, a $5 million limit for debris removal. You might have a $100,000 limit for loss adjusting expenses. So not every expense you incur would necessarily be available to you up to $50 million. So if you have a huge building that burns to the ground, and you need to scrape it and start again, and you have $250,000 of demo, that might not be enough. You want to talk to your broker about what you have and make sure those sublimits match up. Particularly if you have a rental property, there is lost business income insurance in almost all of these property policies. A key recommendation I have here is to make sure you also have sublimited coverage to hire a forensic accountant to help you put together your lost business income submission. Because what every carrier does, either in-house or externally, is hire a forensic accountant. And they'll say, hey, because your property was offline, you saved XYZ expenses. And we can easily add up your lost rents from leases you had to, and tenant relocation expenses, et cetera. But then you're gonna have an argument with them about, well, did you indeed save these expenses from certain parts of the common area, CAM charges, et cetera? These policies will have, anywhere from 1,000, which does you no good, but to $500,000 worth of loss adjusting expenses to help you hire professionals to have those arguments on your behalf with the carrier, and the carrier pays for them. So it is extraordinarily valuable. And unless you have a crack internal accounting team that is super organized, get that coverage. Another point, and this is one thing that sometimes even sophisticated brokerages overlook, depending on where your properties are located, and particularly if they're located here in Washington, don't let the insurer slip in a choice of law clause into your property insurance policy. You want it to be interpreted under the laws of Washington rather than the laws of New York or elsewhere. They're better here. Carriers sometimes like to stick in, on page 87 of your insurance contract, hey, if we have a dispute about any of this, it's going to be under New York law. There are arguments for invalidating those clauses, but including a statute in Washington, but don't have them in there in the first place, and you can avoid that argument. Okay. Again, as with liability claims, you want to notice these things as quickly as possible. One thing to be aware of is insurers sometimes assign adjusters who are not located in Washington. So they'll have someone from Texas or Florida put on your claim. And
we can say more than sometimes. It's like most of the time.
Many times.
Yeah.
You should ask for someone local to be put on your claim so they can come out and put eyes on your building and understand the scope of the loss. Because you don't really want someone adjusting your claim from behind a desk based on photographs. I would argue that's inherently unreasonable on the insurance company's behalf, but it happens. Push back on that. And you want to put together an inventory as well of things that are damaged, particularly if you have a lot of computer equipment or business personal property, office furniture, etc. I know if you have photos of it, great, but gather your receipts of when you purchased it. If you can't do that, put together a spreadsheet, link to where you can buy it from wherever. This is all part of the leading horse to water thing. Don't give the adjuster sort of room to wiggle here. You want to say, hey, I had this really nice table that I bought. Here's the receipt. I need to replace it. It now cost me $8,000. It's now $12,000. You got to put all this in front of them and don't let them swerve, because then you will get more money out of it that way. On the building loss itself, insurers use software programs, one in particular called Xactimate, to estimate the cost of repair. And they will come in with either their own adjusters or some building consultant they'll hire, who's usually not a licensed contractor, but sometimes is. And they'll plug in the square footage of your home or your building, and it'll spit out, this is how much the drywall should cost. This is how much the electrical should cost. Almost invariably, no contractor will do the repair work for that amount. It's just typically unreasonably low. And so you're going to have an argument with your carrier very frequently over the actual cost to repair that you get bid by one or more contractors and the amount that their software spits out. And they're going to say, I want to pay $800, and you're going to say, well, the quotes are actually $1 million, and you have a $200,000 fight. Go ahead, sorry.
No, I have
Okay,
nothing.
yeah.
It's just I'm nodding my head in
Yeah.
agreement. Yep, that's how it goes.
So this happens all the time. And this is somewhere we get involved, or your brokerage can get involved. And, there are arguments to be made to say, hey, look, we appreciate you have a software and it gave you a rough order of magnitude. In fact, drywall costs more than it did, or you're not accounting for the fact that you have to cut around windows and mud and tape, and lumber is now X when your software input it as Y. And so don't take their initial number as the final number or gospel. You can have a dispute with it and push back. And if the dispute gets to a point where there's an impasse, all these policies have an appraisal process where you can go through, each side gets to appoint their own appraiser, and then they usually appoint a neutral. And if it's a valuation dispute, those three people get together based on the actual data and come up with the number that you then get. And it's better than what they started with.
Yeah.
You may also find yourself in a dispute about what caused the loss. And this is the key to it. I should have started with this, but this is the key to every property insurance claim, is causation, right? Is the cause part of what's covered in your property insurance policy? The best property insurance policies are what they call all risk policies, meaning every single risk in the universe is covered except the ones that are listed in the exclusions. There are named peril policies that provide narrower coverage. So wind, fire, hail. You can purchase those. They cost less. I don't recommend it if you can get the all risk, because then what you're arguing over only is whether it's excluded, which the insurer has to prove, as opposed to whether it's covered, which you, the policyholder, have to prove. And then you may need, it's a fire and they think it's arson or something. You get cause and origin experts, and the experts are fighting over these things. So there are costs to incur sometimes on large property loss claims. But if you incur them correctly and astutely, you usually make money on them in the back end.
And I think the key for property owners here is just thinking about different activities that are happening on your property. So the biggest one we see is construction activity. And you got your casualty policy, you're all fired up, and then someone's going to come and do either tenant improvements, or you're going to materially change the property with construction activity. My understanding, and Greg, maybe you can shed some light on this, is that now you're in a situation where you'd better have a builder's all risk policy or some other coverage for that construction activity, because most of the time those are going to be causes that aren't going to be covered by your standard casualty policy.
Yes, certainly if it's ground up, you need builder's risk. Oftentimes a master policy will provide some course of construction coverage. So consult with your broker about whether that course of construction coverage for renovation type things is included in your master policy. Frequently it is, but definitely if you are starting afresh, yes, you need builder's risk insurance. And
yeah, maybe the key takeaway is just, hey, change the activity, check with an advisor on whether you're covered or not before proceeding.
Yeah, exactly. Another issue that might come up is where do you have to replace your property, and with what do you have to replace your property? So we had a client, I'll just give an example, who had a large vegetable processing warehouse that burned down, It was too close to a railroad track when it was originally built 60 years ago to put back there. And so they moved the plant to a new location across town where permitting permitted them to rebuild. The issue was, well, hey, do we get the insurance coverage cost to build this new building in the location, or do we get the amount of a hypothetical rebuild of our old building where it was? The answer is the hypothetical rebuild. So you don't have to rebuild your property at the same location, but you don't get more if it costs more to rebuild elsewhere.
Still subject to those limits.
Still subject to the policy limits, yeah. And usually the policy will use a phrase along the lines of, we the insurance company will replace it with like kind and quality or similar kind and quality. So you don't get to totally upgrade your facility on the insurance company's dime. I will caveat that with, however, if you have a 70-year-old building that's, timber and not fire sprinklered and totally out of code and nothing you'd ever rebuild again, your policy has code upgrade coverage in it, almost certainly to pay for it if you had knob and tube to now put proper wiring in.
Mm-hmm.
And you don't, if before you had a manual assembly line and you want to put an electronic assembly line, there's room to negotiate about those things because of practical realities, but you don't get to if you had a CD player, you don't get a new fancy Apple Mac or whatever,
Yeah.
right? I mean, so you can't upgrade it in sort of a cheeky fashion, but you can in a commercially reasonable sort of, let's talk about the practical realities of what we can't build.
Yeah, that makes sense.
Another thing that people sometimes get miffed and confused about is the difference between replacement cost value and actual cash value. And if you have a long and large property loss claim, you can ask for an advance up front, and the carriers will frequently say this. The policies all say we will only pay you the actual cash value, meaning the depreciated value of your property, unless and until you replace it. Because they don't want people saying, hey, my house burned down. It was built in 1950. The depreciated value is $150,000, but to rebuild it with replacement cost insurance, which almost all these policies have, it now costs $800,000. They don't want to pay you $800,000 and then you decide you'll never rebuild it and you go off and do something else. They will pay you the actual cash value until the repairs are complete, and then they will pay that delta between the actual cash and replacement cost value. Now, frequently people are not in a situation to pay these contractors the monthly bills of $50,000, $100,000, $200,000. So the carrier will make advances, and you can request advances along the way. They just don't want to get ahead of the ACV payments and have insureds abscond with that delta.
Yeah, and if you haven't had this situation before, I would just keep in mind that if you have a loan, 5, 10, sort of multi-million-dollar loan on your commercial property, those loan documents almost 100% of the time have a provision that says that all insurance funds need to be held by the lender, and they're sort of drawn out to make payments. And that typically can be negotiated at the outset of your loan documents to create some smaller dollar amount leverage there, because what you don't want to have is a situation where you've got a $30 million asset and there's a $100,000 claim. It's just under large loss, and they're making you send that money to the lender first, wait 60 days to get reimbursement. So that's a thing that you want to keep in mind when you're doing your real estate loans.
Yeah. One other thing that I've seen a few times on the lender requirements is that the lender will have some clause in those docs that says, before we release any of these progress payments, we send out a consultant to evaluate whether the work has in fact done, and you, the building owner, have the pleasure of paying that consultant $2,000 every month that they come out to do that. So watch out for those. If you can avoid that, that would be good. The timing of building it, often the policies will say, hey, you have to repair or rebuild within 180 days or 360 days, et cetera, which is frequently impossible, given permitting, given construction lead times. Keep your eye on those clauses in the policy. Carriers almost always say, yeah, we got it. We know you're intending to rebuild. We're not gonna say when the 360-day window hits and you're 40% of the way done, sorry, we're not paying anymore. But just keep an eye on that, have those open lines of communication with the adjuster and say, hey, we notice this clause is in the policy. Please confirm you're going to waive it. And they usually will. If they don't, call me, and then they will. The last thing to think about with property insurance is another kind of gotcha. Every property policy has a clause in it that typically says, hey, if we have a dispute, we, the policyholder, and the insurance company, that dispute needs to be filed in court within either 1 or 2 years of the date of discovery of the loss or of some date certain. Again, the carriers will usually toll that clause and extend it if the rebuild isn't complete or you're in the process of negotiating numbers or you're in a dispute. But you don't want that clause to run because the carriers will then say, hey, the statute of limitations is essentially barred for you for a dispute claim. There's a workaround in Washington on that. The basic rule is you sort of lose your breach of contract claim, but it doesn't mean the carrier is relieved from paying your otherwise covered property loss. So you then are kind of left with suing them for bad faith failure to pay if they don't pay. But this is another dispute you can avoid with just open lines of communication with the adjuster.
And that's the actual suit against the insurance company, not the suit against some third party to collect or defense obligations. So you don't,
Correct. Yeah. The liability policies do not have similar clauses. This is unique to property insurance where you, the policyholder, are having a dispute with the carrier.
Okay.
Yeah. There may be signs along the way that you're reaching an impasse with the carrier and that you want to call Imants or me or get your brokerage claim department involved. Obviously, if you get a denial of coverage, that's very clear.
Exhibit A.
Yeah. Or if they're unreasonably delaying responding to you, sending really low ball offers. You think it's $1 million to fix, and they're saying it's $200,000. All of a sudden, you start getting communications from an attorney on behalf of the insurer, or communications start coming from an adjuster who is in what they often call the special investigations unit. And this is when they think the insured is fudging their claims and improperly inflating things. And if that happens again, you're going to want to get a third-party professional involved to help you guide through those pitfalls and processes. Because there is I shouldn't say almost certainly, but the first number in property loss that comes back to you is almost never the final number. You can always do better. And the resources that you would expend on an accountant, and you might not even have to if your policy has coverage for that, are usually money well spent in closing that delta in your favor. You might spend $10,000 on that and get another 80. It's easy math. So yeah, that's really it. And just like for liability insurance, property insurance, you can have similar Consumer Protection Act or Insurance Fair Conduct Act bad faith claims. And in fact, those type of claims are often cleaner in the property insurance world.
I think with that, thank you, Greg. That was all incredibly insightful, and no doubt we'll be sending our clients to watch this video in the future to learn a little bit more about in great detail about what and how to handle those situations. We got a few questions prior to the webinar, so we'll go through those, and we're going to try to address some of the ones that have been sent in on the Zoom. So keep those coming. If we don't get to all of them, we'll try to email you, or you can always email us, and our contact information will be available after the webinar. The first question we got was trying to figure out how to assign relative values of coverage to structures and various forms of liability. So property, injury, and then the pros and cons of under or overvaluing those elements.
Yeah. We touched on the property one a bit before, which is the recommendation is to get an appraiser once every couple of years to make sure those values reflect the actual replacement value. On liability insurance, they call social inflation phenomenon. There have been increasingly large jury verdicts, particularly in King County, less so in some of the other counties, but still, what many lawyers view as kind of outsized and large plaintiff verdicts. So for liability claims, I mean, bare minimum, $1 million, but umbrella liability insurance is not expensive, relatively speaking, and you should have plenty of it.
Yeah, that's kind of like a standing thing for me in terms of these coverages. It's like, yeah, whatever you do, if you have a house and a car and a business, you should go and buy umbrella coverage. And correct me if I'm wrong, but umbrella coverage basically is just, hey, I've got coverage on each of these things, property coverage and some general liability coverage. And if those limits are hit, then there's this extra sort of umbrella covering all of it that you can go to.
Yeah, oftentimes it's part of the business owner's package policy. You know, you'll get in one policy, general liability, property, and then an umbrella. But the umbrella protects you for excess liability. So,
Excess, that was the word.
yeah. So, I would recommend it. It just depends what kind of business you have, but minimum 5 million, even if you're a professional individual, and it costs hundreds of dollars a year, not thousands and millions for individual. For businesses, it can be very expensive depending on your loss history and how bad your loss history is. But relatively speaking, adding excess liability insurance is usually inexpensive. Again, it depends on the nature of your business and your loss history, but strongly recommend you asking your brokerage about, if you just have $1 million, ask them how much it costs to get more.
Yeah, and this is critical about the social issues and what we're seeing in these dollar values. I would say in the last 3 or 4 years, we've seen an increase in claims that are just out of control. $10, $12 million wrongful death claims. These are situations that are clearly beyond the control of the property owner, but it's asserted against them. And so there's coverage both for defense and obviously covering this. And fortunately, the ones we've seen have had the coverage in place, but we're constantly looking at different agreements that have a lot less coverage than would have been desirable in those claims here in King County.
Yeah. So one of this part of this questions was the cons of sort of under or overvaluing those elements of your portfolio. Obvious con, if you have a catastrophic loss and you're underinsured, you don't have enough. The other con is every year, usually you submit an insurance application, and at the end you attest to the accuracy of the information included on that. There is a statute in Washington that says essentially misrepresentations on an insurance application won't void the coverage unless there was an intent to deceive. Courts have interpreted that, meaning that if there was a knowing misrepresentation on the insurance application, that is presumptively intentional, and then it becomes the burden of the policyholder to prove that you mistakenly, massively undervalued your loss. We have had long, expensive litigation over that, so it's just not worth it to do that to save money.
And not to take the longest time possible to answer the first question out of the gate, but when you undervalue, you're likely in breach of your loan documents. So, they're going to have certain provisions that say you're going to insure at least up to certain amounts, and there might even be replacement value or something like that. And if you're off, you may have bad boy carve-outs in your guarantee that would trigger personal liability if you violate a clause like that. So I would be really skeptical of an approach of undervaluing your assets. Another great question we got was, does pooling with another property owner make sense? Or are you always at the mercy of whoever makes the claim driving the rates to increase, and therefore it's a bad idea?
Not to punt this one, but I would go to your knowledgeable broker on this. We have several clients that are multi-party property owners that are participating in pooled insurance programs with dozens or hundreds of other property owners around the country. We typically do that because those come back with, according to their brokers, with the best premiums. The premium is going to be dictated again by the individual property owner's loss history, but also program-wide losses, and then macroeconomic trends that you don't really have any control over. So, every year your broker should be shopping around your coverage to see where it can get the best coverage for the best price. The best price doesn't necessarily mean the best coverage, so you have to make sure that you are comfortable with the
if you get a cheap policy and it has less coverage, are you comfortable with that risk, taking on that additional risk? The concerns about premiums can sometimes be slightly alleviated by increasing your deductible or your self-insured retention. So if you're willing to take on more risk of low dollar claims and increasing your deductible to $25, $50, $100,000 and just not calling the insurance company when you have relatively small claims, then you can save some dollars on premium. But you want to make sure that those savings are worth it to you to take that to then take.
So that's a great segue into a question we get a lot, and I see it on the board, so I'll ask it here. There's this dichotomy when you get a claim in of, well, do I tender this claim? It's just high enough to be maybe worth paying the deductible, but maybe not. Is there a middle ground here? Do we tender and then come back and get that off our record, or what's the dynamic? Or is it just every time we've got to talk about it and make an evaluation?
Yeah, I mean, I always recommend tendering because that's why you bought the insurance, but you might get different advice from your broker on some of those questions. Certainly with claims made coverage, I mean, if you don't tender and you think this is not a high risk claim and it's meritless, but it later turns out there were a bunch of bad facts you weren't aware of, and what you thought was a $10,000 claim is suddenly a $200,000 claim. Because of that claims made notice issue we talked about at the outset of this, you're not going to have any insurance anymore, and you're going to be out of luck. So,
yeah, and I think that does bring up a great point that you can evaluate the claim all you want in that moment, but defense costs and other costs that pile up, could take you well over your deductible, way more than you were thinking. So
yeah, but if you have one sprinkler pipe that breaks and you need to spend $4,000 tearing out drywall in one unit, maybe that situation you make a decision to just do that.
And if you do that, you haven't tendered, but you go in and the claim amount seems to jump. Is there some bar from coming back in a few months and saying, oh, I thought it was this, but I took action to mitigate, and now it's a much bigger issue?
What you will likely face there is an argument from the carrier that it was prejudiced by its inability to investigate and make its own evaluation of the cost. If you take a bunch of pictures and have a good documentation about what you did and don't lose evidence, you then have a good argument that the carrier can't really win its prejudice argument because everything is still there.
Yeah.
So yes, you technically were late noticing, but that breach of the prompt notice clause didn't cause the carrier prejudice.
And I'd say this is an area where in the 19 years we've been practicing, or almost 19 years, things have changed dramatically. I mean, when we first started practice, your relative technology and ability to take pictures and photos was at, say, 1 out of 10, and now we're kind of 10 out of 10. So, we typically are telling our clients, make sure you're out there with your cell phone, get a picture of what's going on, get a video. Some of it may or may not be admissible evidence in court, but it's going to be something you can show to say, here was the status. We can all look at it. We preserved evidence.
Yeah. And again, I have to caveat that comment. That is true of occurrence insurance. It is not true of claims made insurance. So timing is super critical. The prejudice question is not in your favor on claims made.
All right, I just want to make sure on the Zoom up here that we've got, if there are any other questions, I covered them. I saw a few and I think I got to them, but if there's a way we could show that, that'd be great. So this is a good, okay. So when joint property owners divorce and remain on the deed together for a period of time until the property is sold, what is the impact on the homeowner's insurance, where one ex-spouse stays in the home and the other lives elsewhere?
Well, so the homeowner's insurance is going to have a couple aspects of it. It's going to have liability insurance and it's going to have property insurance. If memory serves, there are clauses in there talking about who qualifies as an insured and whether or not it's their permanent residence. So I suppose there could be a situation if the ex-spouse is no longer there and he or she is sued, does she still have insurance under that policy? I mean, you'd really have to look at the insurance contract for me to be able to answer that question. I would think that a non-resident owner of the property is going to want to make sure he or she has liability insurance that covers them wherever they are now.
Yeah, and this brings up a great point, actually. This is like a horror story that we see and have seen, unfortunately. It's not something that that was caused by our firm or anything like that, but a failure to adjust the named insured on policies. And this is one of those areas where you just won't have coverage. So if you transfer real property to another entity, maybe even you wholly own that entity, do not assume that the named insured just automatically changes. You need to contact the insurance company, get the named insured changed to your new entity, or if you come out of the entity and now you're going to go to individuals. We see this a lot in the context of preparing for a 1031 exchange, where there's a bunch of, there's a bunch of owners of an LLC and they drop it out to the members. And now instead of the LLC owning it, there's 5 different members as co-tenants, as individuals. You want to get that named insured change. Now, there is going to be some argument that they're covered under some language in the policy. We never want to be in that world where we're having to make that argument. We want to see the named insured on there and just no arguments or questions about it.
Yeah. Typically, the property aspect of every property policy, and probably your homeowner's policy, will also say, we, the insurance company, will adjust losses with the first named insured. And if 2 spouses are, I guess ex-spouses are still named insured, the carrier may need to communicate with both of them. And if there's some sort of separation agreement that one person gets the house, et cetera, you might just want to clean up the named insured on that issue too, if one of the spouses no longer has an interest in the house.
Absolutely. So look, we have a standing vested interest in making sure that this goes exactly or less than 1 hour. We're very close to that. And so want to thank you, Greg, for coming out today and joining us on the Holmquist and Gardner webinar. And for all those watching, this will be up on the YouTube channel, and a recording will go around. You get an email link to click on or send around to your colleagues or whatever, make sure they understand what's going on. If you have questions, Greg's available, I'm available, and our contact information will show up in your inbox anytime here. So thank you very much for joining us. Thanks, Greg.
Thank you.